Thank you very much. Ladies and gentlemen, a warm welcome and thank you very much for being with us today. I am Anne Michaud, Associate Dean for Pedagogy at HEC Paris. And on behalf of the board, I am very happy to introduce this webinar today. For these webinars, the permanent faculty of HEC Paris selected and proposes topics of interest to feed our reflection and decision-making in this complex period. Today, Tomasz Michalski, Associate Professor of Economics, will talk about the coronavirus recession and more specifically about its differences from the previous economic crisis we have witnessed. Tomasz, thank you very much for accepting the invitation to speak in this webinar, and the floor is yours.
Thank you very much. Good afternoon, everyone. I'm very happy to share some of my thoughts and speculations about the current recession. I will not give a lot of numbers or predictions. I will rather try to frame how we could think about this entire situation. Let me offer you a very quick summary of what we're going to go through. First, I will start with some technical definitions and some historical regularities so that we are all on the same page. I'm going to define the principal object we're going to talk about, the gross domestic product, what a recession is, and also a related concept that is going to be the output gap. Then we'll move on to understand what has happened in the last 2-3 months, how we had different supply and demand shocks hitting different economies, and what are the reverberations and possible aftershocks. And then we're going to discuss the aftermath. What are the public policy responses, long-term changes that we may envisage as of now? We'll see what happens. And at the end, we're going to have, I hope, a robust discussion. Throughout the talk, at different points in the presentation, I will take a couple of questions and then move on, and we can revert to a lot of perhaps unanswered things at the very end of our webinar today. So let's start. Let me start with the definitions part, and let me jump into about the most important thing that we're going to discuss, which is the gross domestic product. So what is that? So just to remind everyone, this is the market value of all final goods and services that are produced in a given country during a specific time period. And we subtract from that any imported intermediate inputs. So for example, parts or raw materials, because we are actually interested in the value-added production and that is produced in a given period. So we care about the market value of all final goods and services. This is the single and the most important indicator that people use to measure the economic activity. It's a flow variable, so we're interested in how it's generated within some time period. And it is a measure of current value of added production and not sales, not wealth, it's value added of production. Throughout the talk, I will use data for the US because it has particularly long series and it's still the largest single economy in the world. So let's jump right into this. So let me show you here the evolution of GDP after World War II. This is in billions of constant 2012 dollars. And you can see the blue line represents the value of this GDP throughout the years from the 1946 to this year. As you see, it's constantly growing. You have some periods here where you have some gray dashed region. Those are actual recessions. And you see that during those periods, this GDP falls But in the large scheme of things, this fall is perhaps not that great, including the Great Recession. However, if you look at the real GDP growth rates, when you look at quarter to quarter, you see a much different picture, because here, first of all, what you see is that these growth rates are much more volatile, and they can be particularly abrupt during the recessions, the declines that we actually observe. This phenomenon that we have recessions and then periods of expansions is a phenomenon that is related to business cycles. And we have fluctuations in many economic variables throughout time. We have expansion and recession periods. So the expansion periods typically, as you see, are longer than recessions, not always, but typically. What is more, they're recurrent, but not periodic, meaning, after a while, there is a recession, but it's very difficult to predict when one will occur. Similarly, when we have a recession, it's very difficult to say whether we're going to have an expansion or not. And this is also above seasonal regular changes in economic activity. For example, in the last quarter of each year, we have increases in economic activity. So all this is smoothed out series. This is not taken into account in these calculations. So then the question is, can you predict recessions and expansions? The short answer is no, you can't. Here you have a country that until now, for the last 30 years, Australia, has not experienced a recession. It was in a period of constant expansion throughout this period. So growth was variable. Sometimes it was quarter to quarter. It was around 2%. Sometimes it was in the range between 0 and 1. Rarely was below, but it wasn't never in a recession. So you might ask, well, how do we define a recession? And typically the definition that is used is the Okun's definition. This is used by, for example, the European Statistical Agency, the Eurostat, or the French Statistical Agency, the INSEE. We need to have 2 consecutive quarters of a decline in real gross national product or gross domestic product to clock a recession. So since, for example, in Australia, we had some quarters when we had negative GDP growth, they were not consecutive, and therefore there was no recession over here. In the US, the timing of recessions is a little bit different. It's the National Bureau of Economic Research, which is a scientific committee that dates recessions. They have a more complex definition, but at the end of the day, most of the time, it boils down to having 2 consecutive quarters of a decline in GDP. And these shaded areas over here, they're actually those recessionary periods, and then we have expansions, right? So it's not only about recession. That's a very important thing. It's also about something else that measures economic activity. We would like to know, for example, how far, given our current economic activity, is far from the potential. And this is what's measured by the so-called output gap. We have some potential output in the economy that would be produced with full employment of labor, capital, given the current technological possibilities. And then we have the actual output that we experience in the economy. The difference between the two is called the output gap. We can have a positive output gap when the actual output is above the potential, when we have an overemployment of factors. For example, we have plants operating at a capacity larger than normal, or we have very low unemployment rates that's not a steady state unemployment level. And then we can also be in a negative unemployment gap where we have unemployment of factors. We can be in a recession when we go from a peak to trough. That's a recession. That's a fall in economic activity. But then we can be in a negative output gap also when we have a recovery. And why is it important? Let me show you in a graph over here. These are the numbers of the output gap for the US. As you see, most of the time, the economy is a negative output gap. This negative output gap declines severely during recessions, the shady areas. But then the recovery, although we're no longer in a recession, is actually slow. So from the Great Recession of 2008, 2009, it took the US economy nearly 10 years to go back to the potential, right? So, and this is important because here we have growth. Everybody seems to be happy, but actually we have trillions of dollars of unrealized GDP that we could have if we could push this actual GDP that we have to the potential, right? So this is trillions of dollars of unrealized business. In the Eurozone, we could produce a similar gap. So we have a short time for some questions, given our. Go on.
I think there was one clarification question from Isaac who asked, quarterly variations are computed Q2 versus Q1 or 2020 Q1 versus 2019 Q1?
So here you have quarterly variations versus the previous period. That's how I'm showing them. That's why they're also so variable. This is at that quarterly to quarter rate. Okay, so this is it's important then in the interpretation, for example, whether we annualize this or not, where we take year to year. But here I'm just showing how variable economic activity is quarter to quarter, how variable it may be. Okay, so thank you for this question. And since we're past some definitions, let's discuss now the current recession that we have.
Yeah, maybe, sorry, I take one more question that there was, because you have a couple of questions already. So you have many already. So I suggest I just take one or two, sorry, for the matter of time. There's one from Ellie who asked, how is it possible to have a greater output than the maximum theoretical capacity of the country?
Yeah. So let me answer that directly. The potential output is not maximum that can be achieved. It's the economist's concept of full employment. So you always have something like, for example, transitional unemployment of people. That's 2-3%, that people always change jobs. Now, if your unemployment falls below that rate, you're operating at really high above potential. Similarly, typically it's assumed that if factories are operating at something like 90% of capacity, that's already something where you would be on a long-term average, because if you go to 100%, you go to bottlenecks. So this concept of potential output, I agree, is a little bit fluffy. This is generated by statistical agencies that tell us what will be the potential output that, for example, is non-inflationary, right? So that's how you could understand this. So this is how this graph is generated. We have some measure of potential output from the Bureau of Economic Analysis from the US. And then we plot the actual GDP and we calculate the difference, okay? So let me move on to discuss the current recession. The question is, what causes recessions? Ex post, all economists are going to tell you very nice stories what caused a given recession. A priori, we don't know. Now, there are many causes of recessions. There may be supply or demand shocks. And let me list some supply shocks, which are those that actually disrupt the output capacity of the productive sector. So we have a couple of them that we can list here. For example, in the 1970s recession, we had oil price shocks that increased important factor prices. And given this, we had a tremendous recession in the beginning of the 1970s. In 2008, what's believed the crash in the real estate and the difficulties in the financial sector led to a credit crunch and tightening of credit to private firms that caused the recession of 2008, and we had many aftershocks then. Nowadays, well, the supply side is hit by, at this very moment, by two particular factors. The first, that we have lockdowns in many countries. That is that non-essential businesses are closed. A lot of people are not working. And we also have, on top of this, supply chain disruptions. So even if you're a country like Sweden, that's potentially open up to business, if you have supply chains that supply inputs from abroad and they're closed, you have a supply chain disruption. And Sweden is going to suffer a tremendous supply shock as well. It is, and also will have a recession probably this year as well. And we can have we can think of many other supply shocks. I just named a few over here. Cascading bankruptcies are similar as well. There are some other causes which are related to demand. That is, we can have weak demand. And in our current scenario, this can be caused by the fact that, for example, people are confined, they're not buying, and also massive unemployed, so they don't have the money to make purchases. But there are many other demand shocks you can think of. For example, households may be unable to obtain credit to purchase durable goods or contract mortgages to buy houses. There may be a higher uncertainty about the future, so they will consume less, firms will cut investment, or we can have a collapse of asset prices, which will have wealth effects. People will feel poorer and consume less as well. And in the case of a worldwide recession like we have now, if you have recessions of major trading partners, so if Germany has a recession, UK has a recession, the US has a recession, it's also likely that these countries that are buying a lot from France are going to have a negative demand shock on French GDP. So what is the problem with the current situation? That never before so many different shocks were at the same time and in all countries of the world, right? So if we think about all the supply and demand shocks, for example, in the 1970s recession there was one primary shock, which was the increase in oil prices. Sure, it was throughout the entire world, but you didn't have many other things. Now, you actually, I will argue, you have all the things that you have listed here in terms of supply shocks plus demand shocks that are working against the economy, and we are facing several severe headwinds. So, in January 2020, we were at some intersection of supply and demand. We could say we were at some equilibrium between supply and demand. And then because of these shocks, the supply shifted in. We are producing much less. And also demand shifted in, which means that consumers, no matter what the level of prices would be, would want to consume less. At the end of the day, we are at this very stage at some very low level of economic activity where we have some supply and demand, and this activity is much lower than before. And the speed of the adjustment is rapid and the depth is brutal, nothing that we have seen before on record. So let me give you some, perhaps let me take some questions over here, and then let me go to show you how brutal the adjustment is currently.
Yes, Thomas, maybe there was another short question from Cote, who says, do you consider full employment as natural level of unemployment?
Yes, so basically you can think about this in the calculation of potential output. You have different statistical agencies that use different concepts. But in a sense, what we're thinking of is here, there's some natural level of unemployment. So you can think that people are changing jobs, and while they're doing so, you're going to have some equilibrium rate of unemployment. And this equilibrium rate may depend on how jobs are being lost and found. There may be some deep structural relationships in any economy. So some economies may have lower, some may have higher employment. This is what we have in mind. That's why you actually can have potential output higher than, actual output higher than potential output, though these instances are pretty rare. Let me answer the questions about stagflation, financial markets a little later. Let me first discuss how deep the speed of adjustment is, okay? Here what you have are the first numbers for the first quarter for the French economy from the French Statistical Institute that were released at the end of April. So what do we see is that there's a minus 5.8% change in the gross domestic product in quarter one, quarter on quarter, right? As compared to previous quarter, it's seasonally adjusted. And it's the worst figure that we've ever seen for the French economy since recording began in 1949. If you compare this to the situation that we were observing during the Great Recession of 2008-2009, we had 4 consecutive quarters of a recession, but the speed was never so quick, and it was never so deep as what we observe now in quarter one. And the important thing to retain is that this is just quarter one, so that ends in March, and we only had 2 weeks of confinement in March. So we had supply chain disruptions, but probably quarter two is going to be much, much worse. It's not only France. We also have the same readings in the Eurozone, similar of magnitude. It's minus 3.8% in quarter one, quarter to quarter already. Before most confinement measures occurred. DCB is projecting now that on a yearly basis for the entire year, we're going to have a 5 to 12% yearly drop in the pessimistic scenario. For the US, the number, the quarter to quarter is a little bit lower. It's still negative, minus 1.2, but recall that the US was hit by the pandemic a little bit later, and they closed down a little bit later as well. What is also remarkable is that it's not only typically what you have is investment that declines during these recessions. That's the strongest adjustment historically. Now it's actually consumption. So this is also what is odd about this episode. We'll see what the terrible numbers are going to be for Q2. Here we have another indicator, which typically is reacts with a lag. This is for the US, initial unemployment claims. So even during the Great Recession of 2008-2009 in the US, weekly claims were no higher than 600 to 700,000 initial claims. So the first claims that people had for claiming unemployment benefits. Now we had the numbers in the millions, up to 7 million weekly. And as of last week, 30 million people were unemployed. There were 30 million new unemployed, despite also some limited furloughing scheme that the US had. The International Labor Organization projects now in quarter two, so the quarter that we're now in, that worldwide we're going to have a drop of 10.5% in hours worked. Again, unprecedented. In Europe, we have a lot of worker furloughing schemes that we're going to discuss later, meaning that their workers are not fired. They're kept by the firms, and part of their salary, a large chunk, is paid by the state. Currently in France, we have 11.3 million out of 29 million workers under such scheme, meaning that more than 1/3 workers do not work. In Germany, it's 10 out of 45 million. In Europe as a whole, 40 million. So this is just staggering. We've never seen such numbers before. The numbers that we saw before pertain perhaps to the past. What's important is also what happens in the future. So whenever we look at the opinions of CEOs about what they forecast, what's going to happen in their sectors, they're unanimously bad. Similar things are shown by purchasing managers indicators. They project historically weak economic activity for the months to come. Also, what's important is that you might say, well, there's some sectors that were really badly hit. If you think about it, it's travel, it's tourism, perhaps it's retail stores, some services, live entertainment. But then, 2/3 of the economy is relatively intact, right? But there's also a lot of production stoppages that may be random because of the supply chain disruption that we are observing. And also a lot of them are indirectly hit through indirect exposure to final demand, or there's going to be a long-term investment hit. For example, if you think about the aerospace sector, if the airlines are projected to fare badly for the years to come, it will limit the number of aircraft that's going to be produced, and it's going to limit badly the investment. So Airbus is the largest producer in France. It's responsible for a huge chunk of the French GDP. And then there are also retarded shocks that may hit firms which are related to inter-firm payment problems. That firms are going to default on, for example, trade credit. And these all adds tremendously to the uncertainty that firms are facing. So let me take some 2-3 questions at this stage. How this GDP decrease could be translated into unemployment or future employment policies in the private business arena in France? That's a very good question. Currently, what we're observing is that we're having a furloughing scheme. That is, firms are incited not to fire their workers, but instead to keep them on the payrolls. And this is to prevent the precious firm and worker links to be broken. Now, the question is, how many of these jobs are going to be preserved in the long run? That is, how many firms are going to survive? So it's estimated there are various numbers that are around that 10% of firms are not going to survive. They're typically smaller firms. So out of the scheme, we can think that some 500,000 to 1 million jobs are for sure endangered. And then we're going to see about how big the aftershocks are going to be. But what we may experience very soon also in France is unemployment rates that are going to hover around 20%. Within, say, 6 to 12 months. Do you think the economy will recover V, U, or W? That's a question I'm going to ask to everybody just in a very short period of time. And also, I will comment about inflation very, very quickly. All right, so what is going to happen in the current situation? The worst period, the lockdown may be short, right? It's very deep, but it may be just up to 8 weeks if we progressively reopen after May 11th. There may be some pent-up demand, so people are going to go back to car dealerships and purchase cars to a certain extent. But having said that, there will be a deep hit on foreign production and income. So if 1/3 of the economy is shut, and those are the projections, not only because of the furloughing schemes, This means that for every week of the confinement, we're shredding 0.7 to 1% of GDP per week, right? And this comes out from various different calculations that we may have, from very simple ones to very complex ones that incorporate a lot of network effects. Also, what we have to mention is that a lot of service industries where you cannot stock inventories, you will have, they cannot produce more later on, right? So these industries, plus those that had low margins, they will fight for survival because they missed on a lot of revenues, but they have to pay overheads, they have to pay rent, and they simply may go bust. And even with some loan schemes, they may not succeed of staying afloat. And also what is important is that this return to normal, whatever that we would think of about before, may be long or impossible. So think about yourself. How willing are you to take a flight now to be locked in for 2 hours with 200 unknown people in an aircraft where you share the same air, AC, and the virus may be circulating? So this is a big question for many industries, for many workplaces. What is going to be the aftermath of the pandemic? So the question is, how quickly likely we're going to come back to some pre-crisis output, the pre-crisis situation. Now, unfortunately, if we think about this and we go back to our supply and demand shocks that we can think of, we're going to actually conclude that both the supply and demand side are going to be pretty perturbed in the years to come. So if you think about the supply side, we're actually going to observe an increase of factor prices, right? It's not going to be oil price shocks. The oil is going to be perhaps at all-time lows for the last 40 years. But social distancing, what is it going to imply? Well, increasing labor costs, because, for example, you will not be able to pack as many people in auditoria, in classrooms, in offices, in transport. So that requires higher costs. If we think about making our supply chains more resilient, or because firms are going to go bust, we will have to look for more or new expensive suppliers. So there's going to be increased costs of providing the new goods. So this is something that is going to stay with us. Then everything depends on how we can contain the pandemic. Are we going to have recurring lockdown and supply chain disruption also in other parts of the world due to new waves? What is going to happen through the financial sector, right? Perhaps after a while, the financial sector will be very reluctant to lend to firms because they will not think many are going to be solvent. And we may experience a lot of bankruptcies that will be cascading. So if my buyer doesn't pay me, I will be unable to pay my supplier. And we may see a lot of, especially firms that with lower cash, but high accounts payable, just go under. So the production side will be impacted for years to come. On the demand side, we're going to have weak demand. Probably there's going to be massive unemployment. We'll see how well we can actually preserve the fabric of the economy from before the crisis. We're going to definitely get a credit tightening to households. So it's going to be more difficult to get a car loan or a mortgage. There's going to be higher uncertainty because we're going to be more exposed to unemployment. It will be more difficult to borrow. And firms will be also unlikely to invest. And, wealth is going to be lower, a hit to a lot of class of assets. And we're going to have prolonged recessions of major trading partners. So private demand is going to be weak. So what is the shape of GDP growth in the years to come? Here's where one of the questions already appeared. We can speculate here what the shapes are going to be. So first, the recovery may be still a V-shape. If we have a quick economic turnaround, there is pent-up demand that is going to realize after the lockdown is lifted that there's no change in economic fundamentals. So it's like everyone would be on forced extended vacation. We're back to normal. And it could be compared to a recession at the dot-com bubble, 2001, 2003, that was relatively inconsequential for the entire economy. It could be a W shape if the pandemic returns at different intervals. Economies will seesaw depending on how they lock down and reopen. And this may continue until a cure vaccine is found. And also what we're going to see is that perhaps, because the pandemic is going to hit different countries at different time periods, supply chains may be constantly impacted at a different level. We can have a U-shape economic recovery that is going to be very long, prolonged low economic activity. Many firms, individuals will go bankrupt, high unemployment that will become structural with slow recovery, something that we've seen during the Great Recession of 2008 and 2009. And then finally, we can have an L shape. So high negative output gap for several years with weak growth, massive unemployment, strong aftershocks, just like we had during the Great Depression after 1929. So this is what we're probably seeing in the cards. I'd like to launch now polling through our system. If I could ask the support team to do this so that you can vote what shape of the economic recovery you think that is going to be. Is it going to be a V shape, W shape, U shape, or an L shape? And we're going to take a look at this poll at the end of the webinar. Let me take also here now a couple of questions that are best rated. Do you think that US and European firms will shift their supply chains back to US, Europe, and that governments will promote more national production? So definitely that's something that's related to what I want to talk about, the policy responses, but let me answer that, and let me answer that question later on. Do you think that the European economy might recover more easily together as economic system or divided into single economic systems by country? So I believe that if the EU disassembles or the Eurozone disassembles, the economic outcomes are just going to become worse. We are in a single market. There are deep value chains that permeate the different European economies. If we close down, that's going to be a tragedy. In terms of output, we could see something like a disassembly of the USSR. What steps a government can do to restore maximum employment? Well, let's go forward then and talk about exactly what were the policy responses and long-term changes. So first, what I would like to say is that governments and the central banks of major developed countries already did a lot. And this is an opinion that is shared by many economists. So we have a very strong, unprecedented monetary policy stimulus and also a huge fiscal response that we're going to observe. The problem is that all these classical textbook policy responses may be inadequate to the current situation. One reason is that a little bit related to the situation the central banks and governments are in, and the other one to the nature of the problem. The first is that, for example, if we think about monetary policy stimulus, the interest rates were already low before the recession. So there was very limited space, except perhaps for the US, to stimulate the economy. Then again, after 2008, 2009, and until today, central banks actually did not figure out how they can successfully intervene and stimulate the economy. A lot of things fail. What you see is a failure of classic monetary policy. And for 10 years, economists have not managed to come up with some great solutions how to make monetary policy operative. What is more, currently we are observing very low inflation. If we actually have a huge monetary policy stimulus, a lot of liquidity pumped into the system, and monetization of debt, what we're going to observe is loose monetary policy plus a supply shock. Remember, when we go back, we were going to have an increase in factor prices. There's going to be increase in labor cost. There's going to be a reorganization of work. There's going to be more expensive suppliers. The fact that we had a lot of these suppliers from cheap locations over the last 30 years, this kept factor prices extremely low. Now this might be coming to an end. So we might end up with a stagflation of the 1970s type. But guess what? A lot of economists saying this, if this is the price to pay to get back economy on track, let's do this, because this is also going to help with the fiscal response, because fiscal capacity of states is low. If you think about France, France was hovering around debt that was already colossal. It was around 100% of debt outstanding to GDP. Now already we're going to see it increase to 115%. True, the cost of servicing this debt is extremely low at the moment, but this is dangerous, right? And the question is, well, how long can we add on to the pile of debt? And every time you add to this pile of debt, when a sovereign borrows, for example, we know that the Treasury in the US wants to borrow a staggering $4.5 trillion in the next months. That means also crowding out of funds for the private sector, right? And we might reach fears about solvability of several countries. There is a question, who will pay in the end? Future generations, the wealthy. Are we going to diminish the value of the debt through inflation, right? So this is something that limits the efficiency of classic policy responses. That having said, we have some interesting new policy responses that will help tremendously, especially in Europe. So the first one is that I want to mention is the so-called Kurzarbeit. So it's a scheme of furloughing workers. So they're not fired, they're kept within the firm. That is a substitute for unemployment benefits, but the links with firms are kept. And workers also may quickly return to work after the economy is reopened. It only will work, however, if the employer that does this remains viable. And the question that is going to linger, how many small businesses are going to survive? Then what is extremely useful are government loan guarantees that, for example, occur in France, where you can obtain a loan that is equivalent to 1/4 of your yearly revenue and guaranteed by the state. You can get this loan for several years. This will allow firms to borrow for banks that otherwise would be reluctant to lend, and you will be able to use it, for example, to support not only your current activity, but also to pay up your suppliers, right? So you don't have this cascades of defaults that can very negatively affect the production side of the economy. So the game here is really to preserve the structure of the economy as much as possible, the fabric, the precious links between firms, firms and workers, and firms and final customers. And it remains to be seen how successful this is going to be. So let me take some 2 questions here, and let me go on to final slides. Do you think that private jets business will grow even after COVID-19 ends? Well, perhaps, right? The question is, is it going to be that large to save the entire economy? I doubt it. Okay, so Definitely what we're going to see is probably there's going to be higher demand for cars because people will try to avoid public transportation as much as they can. And you can actually see many more car registrations in the next years to come. So that's, since the European economy is car-based, that may be something like an engine that is going to help us out of this. Temporary layoffs have very little impact on fixed costs in France because the government has to force their employees to take holidays first in order to limit the costs incurred by the government. That's true, but still you can use this scheme for 2 months. Still we have 11.3 million people on those schemes. So to argue that it's not massively used, I wouldn't do that. Do you believe that globalism can help the economy recover? So let me go forward to discuss this, right? What is the aftermath in the long run? And then I'm going to open up the floor to discussion and we're going to see the polls. So all major recessions, so the Great Depression, Great Recession had long-lasting impacts. After this one, we're going to also see a lot of them. First, let me tackle some micro-level issues. I already mentioned this. Social distancing will mean a higher cost of labor. So perhaps we're going to see a new wave of automation, automating tasks, or offshoring, right? So firms are going to try to rescue their business models by offshoring a lot of activities more than they used to before, and especially those that can be teleworked, right? So if you tried out now teleworking and your productivity of some of your workers is not impacted, well, firms are going to think about how to reorganize the office, right? Especially that the office will have to respect social distancing. So we can put a lot of office workers on teleworking, but perhaps some of them, they can be done from smaller cities or from abroad, right? We can actually think about redesigning production chains to have them more resilient. One of the problems that we saw in January and February was that a lot of factories worldwide broke down because a relatively small chunk of the Chinese economy was that around Wuhan was closed. That's 5% of the Chinese GDP. But since a lot of factories were obtaining inputs from that region, this reverberated in the rest of the world. Now, this means that we would like to have production chains more resilient. It doesn't mean that we need to have more production at home. We can just have higher inventories. It just means that we will not probably have just-in-time production chains. We will rely more on inventories, more on warehousing as well. It is true that we perhaps want to keep some of know-how how to produce items at home. It is a little bit embarrassing that it was difficult to produce things that are relatively not that complex, such as surgical masks or that are textile productions, in fact, or gowns for doctors here at home. And the reason was that since textiles were offshored 25 years ago from France, there was no know-how left. So there is going to be some of this production that's going to come back, but since we have so many different countries that specialize in so many different things, it would be ridiculous to actually deglobalize. The solution is have more stocks and still keep the goods flowing. That's, I think, how a lot of trade economists are thinking about the problem. Now, at the macro level, what is going to happen, perhaps because of the huge monetary stimuli and the supply shocks, we're going to have stagflation. Currently, we don't see this, but we're at the very early stages of this phenomenon. Years to come, especially among the weaker countries, we may see debt problems, sovereign defaults. Also corporations, individuals, there may be needs for massive write-offs. And we'll see also problems with geopolitics, strains within the EU. There was already a question about the Eurozone. Today we had a very odd ruling by the German federal court that questions the monetary stimuli tools of the European Central Bank. We may have a furthering of US-China tensions that are going to reverberate negatively on the supply chains. What is going to be also important is managing social unrest, right? First of all, if we are going to experience huge, massive unemployment, this means that whoever is entering the labor market in the next 2-3 years is going to, especially if they're a skilled worker, they're going to see years of lower income. And we may be facing a lost generation that's going to have prospects much worse than their parents. And the high unemployment that we may see may increase the inequalities. There are already indications that some groups, for example, the highest skilled workers, like perhaps ourselves, we can telework. That's exactly what we're doing now. But a lot of people that are in the production sectors, they're furloughed, they don't get any income. There is a very big class skill divide in how this crisis affects people. And then there may be huge changes in taxes, regulations, just to mention a few. Wealth taxes may go up. You may have massive debt write-offs, which are going to punish bondholders. There may be regulations about stock buybacks. It is something baffling that airlines are now bailed out whereas they gave to shareholders $250 billion US in the last couple of years, and they get an equivalent bailout now from the taxpayer. So there's a lot of things that may happen. And definitely it's a turning point. We'll see how this all plays out. So let me finish here and let me just show you one last slide. This is a slide that shows for France how different cities are exposed to the lockdown. What is the percentage of hours that can be teleworked? As you see in Paris, it's nearly 50%. For cities that are very small, below 100,000, it's less than 30%. So there's a big divide, and perhaps very soon we're going to see a return of some kind of a Gilets jaunes movement as there's a big divide between large and the smallest cities. Let me open the floor to the discussion and questions. Let's see what are the questions that are most voted in currently. So the first two questions, we've already covered this. Do you think that US and European firms will shift their supply chains back to US, Europe? My hunch is that no, although what I would say is that we will rely less on individual countries, that is, for example, on China in particular. So this is a big, if we will not probably have reshoring, but companies will look more at for example, European firms will look closer at their vicinity. For example, at the poorer EU countries like Poland, my home country, Romania, Hungary, Bulgaria, or countries within the Mediterranean basin like Turkey, that huge economy, Morocco as well, Tunisia. So we may cut the over-reliance on China. Who is lending to them? If governments worldwide are increasing debt levels, who's lending to them? Well, there's a lot of liquidity in the systems. We also can see that there is something what is in action is the so-called good old central bank printing press, but in its modern form. So basically governments issue debt, banks buy them, and the central bank buys these bonds or treasury bills from the banking system by increasing the banking system liquidity, and the European central banks are holding them. So do you think financial markets will recover faster than the economy itself? Yes, and I think that this is exactly what you're seeing now. Although the markets are, of course, something like 20% off their highs, it's not as bad as it was in mid-March. And the reason for that is that we had a lot of action by the public authorities in both in the classic policy responses and the non-standard ones that have never been tried before. So definitely financial markets are forward-looking. They actually are responding. There are new, very interesting, fascinating papers at how this responds to analyst forecasts of firms' earnings. And indeed, they're going to be lower. What is also to be noticed that if you think about the stock market is on the stock market, you have larger firms, and this crisis may actually see large firms benefiting from the current recession. If you think about Amazon, Amazon's stock prices, are doing extremely well. What is Amazon going to do? Well, it's going to push out a lot of retailers from business, right? So it's going to grow. So there are some firms that are going to grow, and their weight in the stock market indexes is also going to be stronger. Do you believe that a more state intervention will help to overcome inequalities that we have experienced, especially in the labor environment in these recent years? So it depends what we mean by state intervention, right? So I believe strongly in state intervention in terms of education, right? So we need to have smart intervention in terms of allowing people to get prime education, to get retrained, to get them back to work. This is the only way. So in that way, that's state intervention, right? There are many things that you can think of about this, right? But just, for example, place-based policies that we're going to suddenly build state-owned factories in depressed regions of northern France, that's not going to work. What should I do with my savings in this environment? I cannot comment on this. This is beyond the scope of my competence today. What about inflation outlook in midterm and long term with the massive money injection? This is a very interesting question because on the one hand, we could think that given the supply shock and the amazing liquidity that is pumped into the system, we're going to observe loads of different inflationary pressures. But we may see what we observed after the 2008-2009 crisis, that all this liquidity will not translate into higher prices if the demand remains weak. So this is going to be an empirical question. I'm sorry not to have a better answer, but better minds than mine do not have an answer either. Let me take one last question before we go off YouTube. What will be the impact on your shock persistent estimation of vaccine and or medications? So suppose that magically tomorrow we get rid of the virus, right? Let's take a look back. What is going to happen in terms of supply and demand factors, right? Well, we will not have to have social distancing, but perhaps we will have to have new expensive suppliers as we restructure our supply chains, and a lot of firms are still going to go bust, right? So we're still in the for some bad ride, at least of the sort of the great recession of 10 years ago. On the demand side, we'll still probably will have massive unemployment, right? Credit tightening to households, to firms, you know, I don't expect the stock markets to recover very quickly to their previous highs. There is a hit. There's going to be a hit to the earnings of firms, no matter what. Of course, the longer it takes us to find a cure, a vaccine, the longer it takes. One additional day of a lockdown, one additional week of a lockdown costs us 0.7 to 1% of GDP lost. Okay, thank you very much. Can we actually take, so what we're going to do now, we're going to ask about what was the polling results about the shape of the recovery. My bet is actually an L. I'm pretty pessimistic because of also all the policy aftershocks. Most people think it's going to be U-shape, 42%, W-shape, that we're going to have a recurrent lockdowns and openings, and an L-shape, 16%, 10% only think it's a V-shape. Let's hope it's a V-shape. Let me actually go now off YouTube, and if you would like to stay for ask me some other questions, I'm gonna stay for 20 more minutes. That's my time limit, and I will try to address any questions you might have. Anything from the moderators?
Thank you very much, Thomas. I will, in fact, there are many questions, as you could see. I suggest maybe you start with the most voted on, because it's hard now to find some red thread within the discussion. So I suggest you just take the couple of questions that are most voted on, then we'll continue.
Okay, so Isaac's question